Good afternoon, ladies and gentlemen, and thank you for coming. It's a wonderful turnout, and I hope you'll find this worthwhile, personally as well as financially. We have 4 experts here who have very different types of expertise, so they'll share their knowledge with you, and I hope that after that we'll have a very lively and difficult Q&A session. Please don't refrain from asking the hardest questions that you have. But first, the routine is as follows. Each speaker will speak for just about 5 minutes or so to give you their general take on how they see the world for investment from different points of view. Kathy will talk about the global macro picture as well as the broad picture on currencies. Kevin, I understand, will talk about the Singapore market. After him, Terence will also talk about the Singapore market, but in the broader context of the economy as well. And then Sui Jau will talk about funds and how you can invest through funds and how you can allocate your assets across different funds. So without further ado, it's wonderful to have ladies first. Kathy, you go first.
Hi, thank you for joining us today. So I'm going to talk about, kind of focus on currencies and, how the U.S. economy is doing and how the global economy is doing, because that affects how different asset classes, including equities, treasuries, or bonds, and, any of the exposure you may have abroad will do. So I'm from the U.S. and I live in New York, so I can kind of give you a first-hand view of how the U.S. economy is doing. Now, many of you may be reading in the papers about how the U.S. economy is improving, and there's signs of upside surprises and economic data, and that's certainly the case. I think that for the most part, the U.S. economy has bottomed out. The property market in the U.S. has slid significantly in value, and you're starting to see evidence that homeowners are beginning to increase their prices a little bit more. So that tells you from a housing market perspective, we're getting a little bit of improvement, for most Americans. On the labor market, for the most part, the U.S. economy is generating jobs. We're no longer in the phase where we're losing jobs. So this past Friday, we had a horrid non-farm payrolls number. Everyone was saying about how it was much weaker than expected. But at the end of the day, the U.S. economy is adding jobs. And so we're in a phase where we are improving. It's not the kind of robust amount of growth that everyone had hoped for, but it's not going to be the sore point of the global economy anymore. It's going to contribute positively and not negatively to global growth. Now, the biggest question that most people have is, QE3 or no QE3? Is the Federal Reserve going to come out with more stimulus? Well, we've been having, from the U.S. dollar perspective, many ups and downs as a result of what the Federal Reserve is or is not saying. Over the past week, we had a nice, tremendous rally in the U.S. dollar against the euro, against the Australian dollar, against many other currencies. So I get a question a lot about whether this is going to last. Well, the only thing that I want to point out is that the rally in the U.S. dollar was caused by what people say are hawkish FOMC minutes, meaning in the minutes from the most recent Federal Reserve meeting in March, the Federal Reserve sounded pretty optimistic. Well, this meeting was from about 3, almost 4 weeks ago, and so the minutes was from that date as well. 2 weeks after that, Federal Reserve Chairman Ben Bernanke came out, and he was like, no, I think that the labor market is not sustainable. Those gains that we saw previously are not going to continue. So everyone is reacting to news that happened almost a month ago, when the Fed chairman came out 2 weeks ago and said, we're not that optimistic. So which one do you think should matter more? It's obviously the more recent comments and not the meeting minutes from a meeting much longer ago. So that is why, in the near term, I think that from the most recent labor market report you saw in the U.S., that is proof that the labor market gains are not sustainable. I mean, yes, we will continue to see positive job growth in the U.S., but it won't be to the tune of 200, 250, 300,000 every single month. So what you can expect is that for the next 2 years, the Federal Reserve has already told us they're not going to do anything. Interest rates are going to remain unchanged till 2014. So the question then becomes, is there going to be QE3? Well, QE1 and QE2 received a tremendous amount of criticism. Some say it worked, some say it didn't work. So if the Federal Reserve were to implement QE3, it would have to be a pretty seriously bad situation for them to do so. So at this point, it's not necessary because there's no seriously bad situation. Obviously, if Europe blows up and we have another, kind of acceleration of the European sovereign debt crisis, that could prompt more action. But as we stand and where we sit right now, it is not necessary. So in terms of the U.S. economic outlook and the dollar, I think what you're going to see is that the U.S. is going to contribute positively to growth. Dollar-yen will probably continue to appreciate. And in terms of the other currencies, the dollar will continue to appreciate against the euro because the European sovereign debt crisis has a whole host of problems. Will probably get a lot more serious over the next year. So that's the perspective from the U.S. What's the other kind of big contributor to growth? Well, that's most certainly China. And we've seen from the economic data that the Chinese economy is slowing. But it's not so bad. I mean, a slowdown to 7.8% growth is still a relatively good amount of growth. In the U.S., we would only hope we get half of that. But I was just in Beijing not too long ago, and I can tell you also firsthand that consumption is strong, and people feel very optimistic. There's a lot of spending, a lot of tourism, and so from an economic perspective, there's all signs of a soft and not a hard landing. And the only other thing I want to add is that the Chinese government will continue to provide support. When the People's Bank of China last met, they had their first quarter monetary policy meeting. They made a little change to their monetary policy statement. And I wrote this down, but I'm not going to bore you. The new sentence that they brought into the monetary policy statement is the same one they introduced in the fourth quarter of 2010, right before they engaged in aggressive monetary tightening. Now, of course, they're not going to tighten right now. But the fact that in the first quarter, their most recent meeting, they added this new language and they changed it from the previous one. And if you're interested later on, I could read it to you if someone asks. It tells you that they're getting ready for some action. And given that the economy is slowing, that action is going to be more stimulus. So even if we get a little bit more of a slowdown in the Chinese economy, the People's Bank of China will sweep in relatively quickly with more stimulus. So on one side of the world, you have one central bank ready to support their economy, and things aren't so bad in China. And the other side of the world, you have the U.S. economy doing okay, not great, but not going downwards at least. So from that perspective, those two centers of growth will help to keep the global economy supported. Now, with that in mind, Europe is a big problem that can cause hiccups along the way. It may not derail the global recovery, and it may not cause a global financial crisis #2, but it will cause nervousness and uncertainty in the markets that will not make it a one-way uptrend, that will bring us bumps along the road. And Europe is a whole other discussion that we can have, but at the end of the day, in the papers recently, they talked about how in France, the situation is so bad that people are moving into tent cities. They cannot afford to pay their rent anymore. In Spain, unemployment is at 23%. In Greece, there is a man who committed suicide last week because he said that he'd rather die with dignity than beg for money. And this is a man who was a former pharmacist and not someone who was poor to begin with. So it tells you that it's still very, very bad out there. And it's probably going to get worse because those countries have to tighten their belts and they have to bring down their debt ratios and everything like that. And in order to do that, there's only one of two ways. Cut spending, raise taxes. A really bad time to do this. And so that will cause quite a bit of uncertainty in the markets. So that's kind of my perspective on where the global economy stands and where it's going. And if you want later on, you can feel free to ask questions. I'm also guest hosting CNBC on Wednesday morning between 8 to 9 a.m. So I'm sure they'll ask me lots of intelligent questions as well. So please tune in.
Thank you, Kathy. Relatively optimistic picture.
Cautiously optimistic.
Cautiously optimistic. So it puts us in a good frame of mind. Given that, Kevin, what does this all mean for Singapore and the Singapore market?
I think the I think the rally that we saw in the last 3 months was unexpected. I think all of us thought it would come probably in the second half of the year. So if you look at it, all the good news, in my opinion, is priced into the market, i.e. better US numbers, a soft landing in China, and a resolution of the crisis in Greece. If you look at valuations for the Singapore market, the market is trading at about 10 times historic, 14 times perspective. So it's probably about 10% away from fair value. Okay? Now, how do I calculate that? What I do is I just take the fair value of the 3 Singapore banks, plus Keppel, plus Singapore Telecoms, plus Genting. If I add that to the index, I get a notional STI of about 3,150. So I think that's where the short-term target will be, but I don't think you'll see it this half of the year, probably in the second half. I think going over the next 3 months, I think there'll be more bad news. Now, I think the problems in Europe are quite serious. Okay? If you look at the European economies, government spending is in excess of 40% of GDP. When they start doing curves, so what you are doing is that you are delaying the problem, you're not solving it. So what I'm saying is that you expect more volatility. Every other month, you might have a country having a problem. Okay, so the question is, are you prepared to stomach that volatility? Do you want to become slightly more aggressive in your investment approach? Okay, my sense is that you should still be conservative, still stick with the yield plays. Interest rates are almost zero in terms of deposits. Look at the yield plays. I just collected my CPF money, so I'm looking for yield plays. I can share some with you later. But you have to take a bit more risk, but you can still find reasonable yield in Sing dollar terms. Okay. Now, I think the other interesting thing in the market is certain sectors are going to be counter-cyclical. We had a terrible year last year. This year, they're going to outperform. Definitely going to make some money. I think the other strong investment theme is privatization delisting. You can make a lot of money, and maybe Terence and I, we can share that, how you can identify these stocks. So I think if you're looking at capital gains, it's going to be difficult. If you look at the market volume, there's no volume on the blue chips. There's only volume in the penny caps. So I'm not convinced the rally is sustainable.
Thank you, Kevin. Quite optimistic, even though you say it's not going to happen until the second half of the year. But there are still good picks out there in terms of yield, and privatization delisting is a very interesting point, which we should get into, by the way. How about you, Terence? Do you share this perspective?
Okay, just a little bit of retracement. Back at the start of this year, I think I stood out with the rest of the crowd. I came out with this paper saying that I believe that for this year in 2012, offense is the best form of defense. Because everybody was saying, hey, go for dividend plays and all. I say, no. If you look into history, right, and there's a good, you can look at a few good examples. In 1990, during the worst part of the economic cycle, that's when the markets start to turn around. And turn around very, very convincingly. You look at August 1998, March 2003, during the depths of the SARS crisis, everybody was selling down, it bounced up. And more recently in 2009 March, when everybody was so worried about the whole global economy, right? Everything was just going under. The ships were parked outside the Straits of Singapore. There was no trade at all. That's when the market started to run. And I asked my economist, my economist from my house, and say, when is the worst quarter for this, for at least this period? And he said that it's going to be first quarter. So I said, first quarter we're going to see a turnaround. And first quarter, it did see a turnaround, but I was a bit lucky. It's a bit of flukish call because I didn't expect it to be so strong either. The turnaround was very, very strong, and I did bank on a few sectors, and these were non-consensus calls. One of them was the technology sector. Nobody looks at technology after, I think, 2003, 2004, because a lot of these guys were taken out. Actually, after 2008, when some of the major precision engineering guys got taken out, like Unisteel, First Engineering, even less people look at technology. So I say, guys, maybe it is time to look at technology again, because last year was battered, totally battered on a confluence of negative factors. Declining demand, then you have the US currency shooting up in September, and then finally you have the Thai floods. So it was battered. And fourth quarter was going to be very, very lousy. We all knew the fourth quarter of 2011 was going to be very, very bad. And the results that will come out subsequently in January, February 2012 is going to be unthinkable. It's going to be one of the worst quarters of the last few years. So I said, that is a good time to look at the stocks, because we're going to see inflection points. At nowhere in time are we going to see anything worse than the fourth quarter of 2011. So if you believe that the market or the technology sector is recovering, and we don't need to see a very convincing recovery. The stock market is a very funny one. When it comes up, when they just need to look for the inflection point, the turning point, and that's when the markets will start to run. So technology was something I was bullish about. Construction was another sector that I thought could be quite interesting, because construction, unlike circa or before 2008, where it followed the booms and busts of the economy, post-2008, it is a lot more resilient, and therefore I believe that construction was another sector that was worth looking into. And finally, one of my themes was privatizations and M&A, which, like what Kevin said, we will talk about it a little bit later. So with that, yeah, I'm done.
Thank you. Sui Jau, you have about 400 funds and trusts on offer at your Fundsupermart. So you're probably very well placed to tell us all how would you allocate your assets among these different categories of funds, by country, by sector, whatever.
Okay, we sell many funds, sell about 400 funds. Anyway, maybe I'll just go through how they've performed. It's actually been a pretty good first quarter for most of the unit trusts out there. I think 90% of the unit trusts are all in the black at least. So if you look at the first quarter alone, best performing fund was Lion Global Vietnam. That one was up about 25%, and then followed by HGIF India Equity Fund. That one is up about 25% as well. And then, but it's a good mix. You have Turkey equity funds, also up 20%. You also had a IPO fund, an Eastern European fund, and yes, a technology fund, all within the top 10. And the top 10 funds are all up around 18% to over 20%. Now, if you go into the worst performers, you'll see that actually the worst performers are there simply because they didn't make quite as much money or they were flat. Worst performing fund of all the 400 funds we sold was DB Platinum Commodity. So the commodity funds got hit, but it's not like they lost a lot of money. You know, this fund was down about 6.7% or so. So they were either flat or marginally down, maybe down -5%, -6% or so. The 10th worst performing fund was a utilities fund, BNP Paribas World Utilities Fund. That was down only 1.7%. But yet it was 10 worst. It made the worst performing fund list because, you know, there's only that handful of funds that were actually negative for the first quarter. So we've actually had a pretty great first quarter. You know, technology funds are up 15%. Asian equity funds, most of them are up about 10-11%. US equity funds up about 8% or so. These are all in Sing dollar terms. So asset allocation wise, now back in August, September last year, we actually raised our rating for quite a majority of our equity markets to about 4.5 stars out of 5 stars. So we actually turned quite bullish because of the sharp correction that we were seeing. So actually, after the first quarter has just passed, we've revised our rating downwards slightly. It's not to say we're not bullish. We're still bullish, but you know, it's not super big buy as usual. You know, last time US equity was 4 stars out of 5. We've just revised it down to 3.5 stars out of 5 stars. So we're still positive. You know, we still think it's a great market to be in, but yeah, we think it's okay to to tone back a little bit our expectations on the U.S. equity market because it's actually got some decent amount of gains. China is the one that is still our favorite top market pick for this year and going to the next as well. Generally, it is an underperformer, and we think that because it's underperformer, valuations are still cheap in that market. You know, China went from more than 20 over times PE until now it's at single-digit PE forward valuation levels. You know, and yes, we are talking about the biggest, potentially the biggest, most impact of the economy in Asia, and it's competing with US to be the biggest economy in future. So, you know, there's no reason to be so negative on China because generally, although they toned down some of their expectations of growth, it's like what, 8% GDP growth toned down to maybe 7.5, 7%. That's nothing to be scared of. There's nothing to be so panicky about. Our view on Europe is actually that we don't see a major crisis coming up. Yes, it's still there. The problems are not going to go away, but we view Europe as it's going to take a long time. In the meantime, they've already spent 2 years of worrying about Europe. Maybe give it another 6 months, 1 year, 2 years to continue worrying about it. It won't crash because they've had a lot of time to do things like implement LTROs, try and make sure the banks are liquid enough, etc. So we actually don't see major impetus to pull down Europe to force it into some kind of major crisis. It will probably be a long drawn affair, but something which investors will eventually put behind them and start looking at other things because the problem isn't going to go away. It's a little bit like your Japan nuclear reactors thing. You know, actually they still have to worry about it. It's not that it's just disappeared, but these days who talks about the Japanese nuclear reactors anymore? Nobody talks about it anymore. So that's for Europe. We're pretty bullish Asia. So overall, we are overweight equities vis-a-vis bonds. We are overweight Asia as well. We think that this continues to be the place to be. The valuations are still fairly cheap. You know, we're talking about maybe 11 to 12 times for PE. So generally, because valuations are still quite cheap, generally we still like Asia. Now, what we don't like would be gold. All right, we are actually negative on gold. We are actually not sure how much gold can actually do. It's already done very well over the last 9 to 10 years. It's been almost like a 9-10 years bull market for gold already. So actually we're negative on gold at this point in time because we don't think there's that much upside on gold. It may not crash, but you may go for another 5-6 years of it going absolutely nowhere, stagnant, flatline. So do you want to be in an asset that does 5-6 years of stagnant? I don't think I want to be in. Not especially if there are a lot more value and to be found within equities. That's why, okay, also equities vis-a-vis bonds, we actually like equities more than we like bonds. We are overweight equities vis-a-vis bonds. But that isn't to say that there aren't opportunities in bonds. Actually, high-yield bonds have done surprisingly well. You can have a year where bond funds do very well and equity funds do very well as well. Now, if, for example, if we were to look at the top 10 bond funds this year, first Q alone, right? The top performing bond funds have done between 6 to 11%. Now, we're talking about first quarter. You know, there's still another 3 more quarters. And the top 10 best performing bond funds have already done 6 to 11%. They got another 3 more quarters. Generally, people put money inside savings account, 0.1% for the whole year, they are happy already, you know. But bond funds, some of the best performing, including your high-yield bond funds, a lot of them are high-yield bond funds, and emerging market bond funds have delivered 6 to 11%, the best of the best, within 1 quarter alone, and they still got another 3 more quarters to go. So generally, you can have a situation whereby actually some of these high-yield bond funds can actually continue to do well for this year, despite the fact that I actually think equities will do even better. So it's actually, you know, not necessarily a situation where you must choose one or another. It's just that we still have to have an asset allocation view. So bonds vis-a-vis equities, we are overweight equities vis-a-vis bonds. Yep.
Thank you, Hui Jau. Now it's question time, but I just want to get one big question out of the way, and that is again going back to Europe. Now, I mean, you put a relatively optimistic, I wouldn't say optimistic, but not terribly pessimistic picture on Europe. And I think, Kathy, you would probably agree with that, would you? Because, no, my question is that this focus in Europe has shifted from Greece. Greece is a small country, it's just 3% of the Eurozone. But now we have Spain in trouble. Spain is a huge economy. And it's clear that they do not have enough facilities, bailout facilities, to bail out Spain. Now, if it's going to be this kind of contagious thing and moving from small countries to big countries, Now, I don't know if we should be so sanguine about it and say that it's okay. So I have still some doubts about the Eurozone. Though I like your analogy about the nuclear reactors, you know, I think it's true. It's going to be something that's always there. But the trouble is with Europe, it's going to get bigger and bigger, not smaller and smaller. So I just wonder if, my question is can Europe spoil the party for everybody? And I just want a quick view from any of you.
Well, I think, I do think it's a very serious situation, actually. And I do think that it can be a game changer during certain pockets of time. Because what's going to happen is that Spain's going to get worse. And then that's going to cause quite a bit of sell-off. The ECB is going to come in. They're going to do another LTRO. That's going to help stabilize sentiment. The EU will probably raise their firewall a bit. And then that will kind of bring a little bit of stability. And then maybe it'll come back again. But it'll get worse before you get more action from the central bank. But I think more action is inevitable this year from the ECB.
Okay. Anybody else want to weigh in on that?
Yeah, can I? I think in the US, the subprime loan was the toxic asset. In Europe, the toxic asset is actually the sovereign debt. Now, you actually have to check. A lot of the large insurance companies out of Europe have quite a lot of the sovereign debt. Now, if they take a 75% haircut like Greece, I think the key issue is the recapitalization of a lot of these insurance companies. Now, the question is, I would advise you that if you have a foreign insurer, a European insurer, please go and check the balance sheet. You will probably find that 30 to 40% of their assets are probably European sovereign debt. And then you're going to go down a little bit further, which countries? Okay, if it's any of the pigs, I think you have a serious problem. You need to probably think about it.
Anything to add on that? Anything?
Okay, for Europe, right, I think generally for stock markets, it's the first time when you are confronted with the magnitude of the problem where they see the biggest reaction in the stock market. So this time, not this time, sorry, last year, August, September, October was when we saw the Europe crisis really come into the forefront a second time because people thought that they had sorted some of the problems out already, but it resurfaced, and that was when you saw the maximum amount of coverage on it, on the media, or the news, etc. Right? But at the same time, how many of you realize last year, despite all this negative coverage, we weren't just talking about Spain, whatever, we were talking about the possibility of Europe disintegrating, will the euro still remain and all that. But despite all that, Europe market last year only dropped by 13%. Last year, Asia markets dropped by more than 20%. Asia markets did worse than European equity markets. Why are we so concerned about Europe if even the people in Europe themselves are not so concerned about Europe? We only dropped 13% last year for the whole of calendar year 2011. So I think generally you have to have a certain amount of expectations. So for us, we actually come with the base case scenario that we actually don't think the problem is going to be so serious as to worsen significantly, as to cause a Lehman Brothers crisis moment that's going to happen. It will drag out. It's not going to be solved anytime soon. But like what we were saying, it's going to be in the background. You'll never go away. After a while, investors will move on and say, what else is there? Yes, I know Europe is bad. Anyway, I have not that much exposure into Europe. Can other places do okay despite what's going on in Europe? And I think the answer a lot of them will come to is that yes, a lot of the other places are going to do all right, even with Europe's problems continuing to drag on and on and on. Because if you are looking to invest only after Europe's problems are completely resolved, okay, you have to wait a very long time. That's like saying, okay, back in World War II, I want to wait until World War II is over, then I invest into the stock market. The worst point in World War II was not 1945 when Japan surrendered. The bottom point in World War II was 1942 when they still had another 3 more years of war and dying to go on. So we cannot wait until the Euro problem is totally resolved. I don't know how long you have to wait, but it doesn't mean that in the meantime you just ignore or don't go into markets. There are still markets out there that you can consider, you can go into, even with the backdrop of Europe where it is today. That's my view on Europe.
Thank you. Well, ladies and gentlemen, the floor is open. Your turn. What's on your mind?
Testing.
could you please put your hand up and identify yourself before you ask a question? Oh, yes, thank you.
Hi, I'd like to direct the question to, is it Fundsupermart? Yes, I'd like to find out what is the net fund inflow or outflow that you've seen over the past 2 years. Are you saying net inflows or outflows? Does that question make sense?
Okay. Okay, if you are talking about for Fundsupermart, right, net inflows and outflows. Okay, firstly, I don't know how representative we are of the industry. Okay, our AUM is about close to 1 billion back at the highest. Now it's about close to 900 million now. All right, we may, but I still think we're the biggest distributor there, so maybe there is some indication. Over the last 2 years, actually we have had more outflow than inflow. All right, because the last 2 years haven't been exactly that kind to markets, right? You can see, you know. So generally we have had more outflows than inflows. Now, if you take that as an indication to sell, not the right indication. Because typically at the months where we see the biggest amount of outflows is also probably the times when the markets are cheap, and that's the best time going. Because if we look back at 2007, 2008, 2009, the point in time when the months we had the maximum amount of outflow, those were the time when the markets were at the most panicky and at the worst, because naturally from an investment psychology perspective, big crash in stock markets, when stock markets are doing very badly, people want out of the stock market. So that actually, since we've been seeing more outflows than inflows, all right, over the last, especially last year, the third and fourth quarter, I would actually say that that is a kind of an indication that there are a lot of cautiousness for investors out there, which actually means that there is a lot more upside to markets. At a point in time when you see a lot of inflow, where was that? 2007, near the peak of the market. At that time we had maximum amount of inflow, but that wasn't the best time to buy actually.
Thank you. Kevin, you had mentioned there are opportunities in the yield and in delistings and privatization. Would you like to elaborate on that? What opportunities are there when it comes to yield, and what yield can you reasonably expect to make on your CPF money that you can now draw out?
I think we should all set a benchmark to try and beat inflation. Okay, so you should try and beat 5-6%. I think that's the figure you want. And basically it means that you have to go, if you want to stick to corporate bonds, you're on the margin, okay, because the good class corporate bonds like GLP and all that will probably give you around 5%, or even the Genting perpetual bond will give you 5%. Okay? If you want to go with the pref shares, they'll probably give you 4 to 5%. Okay, if you go further up to the mid caps, the small caps, you can probably get 8 to 10%. Okay, so I think you have to look at the cash flow and whether during the period of a downturn in earnings, whether these companies actually paid. So I think it's in the tech sector where I see a lot of high yield stocks, mainly because the share prices are depressed. And these stocks actually give you two things. They give you a good running yield. They give you a potential for capital appreciation when the sector is re-rated. And ironically, the tech sector is also the sector with the most amount of delistings because the stocks are so cheap. So you've got a decent holding costs plus a good potential for exit either from a re-rating or from a voluntary delisting.
We need some names, Kevin. Can you give us some names?
Later.
Later. Don't forget, huh? No, later he's going to give you a name. Hey, Terence, one of the things that has happened is that the blue chips have led the rally this time, and the small caps have been left behind, as it were. So do you think it's now the turn of the small caps to catch up, or do you think the blue chips will climb down a little bit?
Well, actually, I don't think small caps have been left behind. If you look at what has happened in December, January, the blue, as you correctly point out, the bellwethers of the economy, the property companies, the oil and gas, the banks have all started to run up. But very, very shortly after that, sometime in January, the small caps also started a big run of their own. So year to date, if you look at the small caps, I think it's been up circa 17-20%. Versus the blue chips, the STI, which is up closer to the lower teens. So small caps have made a good run up. But I think in the subsequent quarter or so, we should see a little bit of a pullback. So on that part, I do agree with Kevin. After the strong run up, there should be a pullback. But I think where I sort of maybe differ is like towards the end of it, I think that we are still going to end off higher than where we are right now.
Okay. Okay, ladies and gentlemen, your turn. There's a gentleman here, yeah. Identify yourself, please.
Hello, I'm Pang Chan-chun. I would like to direct a question at Kevin. Basically, previously you mentioned that...
Can you speak up, please? Sorry.
Is this better now?
Yeah.
Okay, I'm Pang Chan-chun. I would like to direct a question at Kevin. Previously you mentioned that the bull run that was expected at the end of the second half of the year was actually came about at the start of the year far earlier than expected. You also mentioned that it's roughly about 10% to fair value. However, I have also noticed that just at around the end of this quarter, the bull run also has significantly mellowed down. That also goes along with the bank stocks, which also significantly had their bull run mellowed down, right now going almost sideways. Do you see how much further upside do you see, if any, for the rest of the year? Or have we seen most of the growth and really won't be seeing much more upside until there's further good news?
Kevin, I think that is for you.
I think if you look at the bank stocks, the bank stocks are about 30% of the STI index. And the bank stocks on paper are very cheap. 1.1, 1.2 times price to book. Okay, so with the exception of DBS, I think the banks are still undervalued. Okay, I think what the investors want to see is that a lot of the banks, we want to see whether the NPLs start to rise. Now, I think the key thing will be when the property market starts to ease off, when the economy starts to slow down, will we see a rise in NPLs which might impact the earnings of the banks? Now, if we don't see any decline or significant downgrade in the earnings of the banks, which I think investors will use the Q1, Q2 result season to verify. That's why I said in the second half, the banks are still very cheap. And because of their heavy weighting in the index, they will actually lead the index higher. The reason why I said, except for DBS, is that I'm not quite happy with the recent acquisition in Indonesia. I think it's a bit expensive, and given their track record in buying expensive assets, and having to clean them up, I think the share might underperform the other two. Okay, and because of this acquisition, because they paid more than 2 times price to book, DBS is now on a pro forma basis for the highest price to book among all the banks. So it becomes the most expensive. So I said you're probably better off buying UOB and OCBC if you want to ride the second half rally.
More questions? Yes, sir.
Thank you. My name is Lim Jui Sek. I would like to ask the panel, particularly for Kathy. Now, for US, over the years, they have been running on this budget deficits, and they have really growing debts, national debts. That's one concern. Two is because of this situation, many countries try to pare down their holding of reserve. Instead of greenback, they go to gold. And there's a rush to buy gold by China, Russia, and so forth. So with these two factors, forward-looking, how do you see the U.S. currency? That's number one. Two is U.S. economy because of this situation. Thank you.
The deficit, does it worry you, Kathy?
Not at all, because at the end of the day, U.S. treasuries are still the safest investments in the world. It's not like we're having this, it's not the same situation as the large budget deficits in Europe. U.S. treasuries are the most liquid. And as a result, even during times, and you've seen this, during times of risk aversion, people will continue to buy U.S. dollars, even when the economy was doing poorly. Look what happened when S&P stripped the U.S. of its AAA rating. The dollar still ended up rallying. Because yes, it is, a big issue, but it's not one that's going to stop people from holding U.S. dollars. If we take a look at the European sovereign debt crisis, and we think it's going to exacerbate then investors and central banks would look to diversify. And China doesn't have an open bond market or open asset market at all. So that doesn't leave many opportunities. And because it doesn't leave many opportunities, the US dollar and US treasuries are still attractive. Now, you're absolutely right. All of this factor is making gold attractive as well. So, I actually have a different view as you. I am long-term bullish gold. And I think that gold still has room to run the upside because we have so many global deficit issues. Also, because if we believe that Europe is going to get worse, and we believe that the ECB will come up with another LTRO program, what that effectively does is devalue all paper money. And by devaluing all paper money, that makes hard assets such as gold more attractive. So I think, yes, gold will continue to rise. Central banks will continue to diversify into gold for many different reasons, but that does not necessarily preclude the fact that the dollar could still rise in times of risk aversion and will still remain one of the most popular safe haven currencies in the world, particularly if the crisis is stemming from Europe and the US is still doing relatively okay.
Thank you. By the way, for those of you who may not have read about it, the LTRO by the ECB, the European Central Bank, is the long-term refinancing operation, which is kind of equivalent in some ways to the Federal Reserve's quantitative easing program, except they're doing it another way. They're providing super huge loans at super low interest rates to banks, unconditionally in the Eurozone. So that keeps the liquidity going and keeps the system afloat, basically. So that's an important part of the European rescue. More questions? Gentleman here.
Good afternoon. I've got two questions, one for Mr. Kevin and one for Terence. The first question for Kevin is that, say for technology stocks, you said they've been beaten down badly. What do you think is a possible thing that will cause the inflection thing to be re-rated?
Sorry?
For the technology stocks, what is a possible thing that will cause the thing to be re-rated?
Okay. What will cause technology stocks to be re-rated?
I think last year you could probably consider the perfect storm for technology stocks. Okay, you had the tsunami in Japan, had supply chain problems. You had a strong dollar which squeezed their margins. A weak dollar that squeezed their margins. And then you had a problem in Thailand. Okay, so as a result of that, a lot of machines will run down, the inventories will run down. So what you are seeing now is a significant pickup. Inventories are very low. I think you're going to be surprised that in order to try and normalize inventory levels to the recovery, you're going to see quite a decent Q1. I think more importantly, the guidance will be better than last year. Okay, now given that last year a lot of the companies had no profit, this year you could be looking at some companies delivering 50% increase in profit over last year. So that's what we call a normalization of profit. Now if you look at the technology stocks, even after the horrible performance, a lot of them are trading 0.3, 0.4 times price to book. The PEs on a historic basis are probably 7 or 8, but forward looking 3 or 4 times. I think it's extremely undervalued, but pick carefully. Okay, I think the key thing is they must be cash flow positive. They cannot be financing their customers.
I think for the tech sector, it has already been re-rated. I believe we were one of the first to do it early this year, but subsequently a couple of other houses that actually cover technology stocks have all re-rated. And if you look at the tech counters in general, they've gone up about 30-40% on average. But some of the significant outperformers were up 70 to 90%. So there's already been a big run in the first couple of months.
Sui Jau, how have your technology funds done?
Okay, quarter to date, year to date, right, technology funds are up about 15%, the global technology funds. So we remain quite bullish on technology as well as a sector. So generally we do see further upside within technology stocks as well. Generally I think it used to be the sector that nobody wanted to touch, but these days, they have decent earnings growth. They don't have some of the problems which you have to worry about for the financial sector. government is not in a hurry to come down and implement all kinds of regulations, and interest rates generally don't affect them as badly as, for example, they might affect banks and things like that. So all in all, they have a lot more positive things going for them. And these days, in the past, it used to be a lot of tech companies were could be zero earnings, not much revenue. You were buying them based on the hype during the internet bubble, during the tech bubble. But these days, actually, a lot of the tech companies are, companies with a pretty good business model, with strong and tested business models with good earnings. So it's a different sector these days compared to back in 1999, 2000, etc. So generally, we have reason to feel a lot more bullish on tech now. Generally, so yeah.
But just to very quickly speak about the difference, I mean the ones that Kevin and we are talking about, the tech companies, very different from the ones Sui Jau is talking about. Because these are the global tech companies, they have already surged in the third quarter or fourth quarter of last year. These are and they've continued to go up. The tech companies we are talking about, that there's a possibility of a potential takeover will be the smallish tech companies that are in Singapore. They are largely manufacturing-based companies.
Since you mentioned takeover, this is a good point at which to ask. If I am an investor, you mentioned that we should be ready for privatizations and delistings. How should I position myself to benefit from this? Kevin, would you like to take that? How would you as an investor position yourself?
First of all, I think you'll have to guess which ones are going to be privatized. I think the tech sector is in a very interesting situation. A lot of the founders are in their 50s and 60s. They have succession issues. Okay, that's the first point. Secondly, you need to look at companies where the major shareholder owns in excess of 50%. And then you will find that they are at a deep discount to their NAV. So then the owner decides that he will work with a private equity fund and he will take it private. And I think almost all the tech stocks are trading below NAV. So look at the ones where there's a controlling shareholder, look at how old he is, try and find out whether his son is in the company. If his son is not in the company, it's a classic target. And while you're waiting for him to decide that he wants to do it, look for a decent dividend yield, because they are now starting to pay decent dividends, because even the owners want cash flow.
Good advice.
But do be careful of some of these companies. The NTA may be extremely high, like maybe 5-6 times higher than their stock price. Then what they do is they'll basically churn out all the bad news. They'll start to write down. So because if they want to take over, they want to take over at least NTA, right? So they bring it all the way down. They flush out all the bad news, millions of losses. People sell it off, and then they'll start to say, they'll take over offer at a slight premium. Then I think it's not exactly ethical, and it's to the detriment of shareholders too. Sorry, you got another question you were saying?
Question for you, Terence. I think you said you with regards to construction companies, you were quite bullish on them after 2008 because they're not so cyclical anymore. See, with these construction companies, with these days commodities have been going up in prices. So is there a concern of them being able to pass on the cost of all these materials and all that?
Oh, that's a good point. But in the construction, the question is, can the construction companies pass on the rising costs of materials? They can, but not for existing materials. And I think another thing that construction companies will have to be wary about is also manpower. So those projects that they have already taken on, but recently the government go and whack big levies on the companies, right, for foreign labor. So those existing projects, they cannot do it. So the margins will thin out a little bit, but for subsequent projects, they'll just pass it on over to the developers. Yeah, but margins will be a perennial problem for construction companies.
Thank you. There's a question at the back. The gentleman in the red striped shirt.
It's okay. Oh, thank you. It's okay.
Hi, name is Steven. I think one thing that you've just touched on a point about inflation. I've been wanting to find out a little bit more what it might be the view on inflation globally, because essentially when we're chasing returns, we're trying to change inflation-adjusted returns, something that will earn us more than our money is depreciating due to inflation. Plus, we can get a global view on that, or even regional. Thank you.
Kathy, since you're the globalist out here.
Well, I think it's really about what part of the world you're talking about specifically. So, for example, globally, that commodity prices are rising. So theoretically, inflation should be rising globally, but it's not. Like in Europe, inflation is actually growing at a slower pace. And that's because demand isn't keeping up with the rise in prices. So as a result, producers have to eat the higher costs and are unable to pass it on to consumers. In the US, you have a little bit of that, you have a little bit of inflation. So you don't have the same degree of inflation that you may have in Asia, but at the same time, it's kind of there. In Australia, you're also getting your demand slowing a bit, and then this currency was strong previously, and as a result, inflation is also, leading more lower than higher. So you can argue that here, you're feeling more inflation, but in other parts of the world, it may not necessarily be the case. Of course, lower prices is not the problem anymore. So the problem that the commodity prices pose is that it makes it more difficult to implement easier monetary policy when needed. But as of right now, it's not a huge issue globally.
Thank you. One more thing on inflation, actually, worth mentioning, is one of the big trends in the world is the increase in wage levels in China. China is going through huge wage increases, starting in the coastal provinces, where they're rising like as much as 30 to even 50% in some companies. And that is pushing up the costs of production in China. Now, some of that stuff will move to the interior, but until that happens, I mean, there would be cost pressures. So I think it's reasonable to expect that inflation will still be there. It's not going to go away anytime soon. And the cheap China goods syndrome may not last as long as we've had it so far. Any more? I think there was another, yeah. Gentlemen.
Hi, I'm Stan. I'd like to check with you. For this year, there will be the U.S. presidential election. So for one of the presidential candidate is Dr. Ron Paul, who is an author for End the Fed. So I want to actually ask, what if this year he becomes president of the USA and he actually ends the Fed? What can we expect?
Ron Paul.
Zero chance that Ron Paul is becoming president. You can write that down, mark my word, he's not becoming president. Because disbanding the Fed would be so nuclear that not only is it impossible for him to become president, but disbanding the Fed is so nuclear that it wouldn't happen at all. Now, at this point, quite honestly, normally the Republican candidate is known by now. But at this point, it looks like it may not be known until June, July, maybe not even until August when they have the Republican convention. So there's a lot of infighting in the Republican Party. So the more likely scenario, because there's no better candidate, is that Barack Obama is probably going to win again. That seems to be the prevailing theory in the U.S., simply because there's so much infighting in the Republican Party. So, Ron Paul is not even on the discussion table for the possibility of winning as president.
Sorry. Can we have another question from somebody? Sorry, excuse me, there's somebody there. Yeah.
Hello. Two of you were saying that the tax shares are the one we look for. Can you give us 3 names?
Names, finally, Kevin, you can't escape. Names, you got to give names.
Well, actually, if you look at our tech counters that we were extremely bullish on at the start of this year, the 5 counters we were extremely bullish on, 2 of them has already been acquired, Adam Peck as well as Neratel. We're also bullish on Broadway, Armstrong. Armstrong, I think, has a good chance of being taken over. I mean, it's been talks for a while right now, but not so soon. Broadway, we are also bullish on. Both of them are riding on the big pickup in the hard disk drive sector. I was talking about the inflection point. We saw it mid-December because at the point in time, every other week, I'm getting feedback from the management. They've been feeding me with information, telling me, hey, things are picking up, things are picking up. So it seemed pretty convincing by January this year. So these 2 stocks. And Hype is another one that we have been, I think we upgraded it about 60 cents. It's gone up about over 50, about 80% so far this year. This guy, first quarter will not be an impressive quarter for them. But we think the subsequent few quarters, because of Apple projects, it should be able to see record revenue as well as record profit for the year.
Kevin, names from you.
Okay, I have the same Armstrong and Broadway as him. And the other one that we have is actually Jukan. Now, Jukan has actually announced a possible scheme with Franken, but it's taking forever. Okay, so when they actually announce it, hopefully you will get a takeout at a reasonable NAV. The other one which I've just started to like is a company called AEM. And I still like ASTI. Now, I think what you need to do is that we are giving you recommendations, but you have to go back and do some homework. Please go and read the results, read the analyst report, read the annual report. Be comfortable with what we are saying. Don't believe us, because we've been telling stories so long. But what we are saying is that we are identifying for you something to look at. Go and do your homework. When you've decided, when you're happy, then make the investment.
Thank you. Finally, Sui Jau, some names from you, since you have so many funds. What are interesting? What are some good funds people should look at?
Okay, if you want to look more specifically at tech sector, Henderson Global Tech is a very well-known, quite a strong performer for the tech fund. If you are looking at, for example, Asia, Aberdeen Pacific Equity is a perennial favorite. Although personally, I like the small caps one more, because I am more bullish, and I feel that actually there's more room for the Asian small caps to actually run as compared to the blue chips. So I like Aberdeen's Asia small cap fund more than I like their Pacific Equity fund.
And in 30 seconds, Kathy, dollar or euro next 12 months?
Definitely dollar, not euro.
Definitely dollar. Okay. On that happy note, ladies and gentlemen, I'm afraid they flashed the timeout sign, so I'm afraid we have to call it to a close, but not before we thank our panelists and thank you very much for your active participation. Thank you all.